right, welcome and good morning, everyone. Thank you for joining us. I know people will be jumping in over the next few minutes, so we'll be able to hop in. But a good thing to note is this presentation is also being recorded, so you'll be able to access the content afterwards as well. This is the third in our Resilience series that we are presenting a great week of content and webinars with the Cheektowaga Chamber of Commerce. But this morning is extra special because we had the opportunity to collaborate with Kathy Paciullo and the membership with the Kenton Chamber of Commerce. And I think it's always better when we can work together and collaborate, and especially when we have content to share, as we're joined by Stephen Turner this morning, who is a CPA and partner with the Bonadio Group. Certainly gone through the ringer over the last couple of years with all of the changes and regulations and information that's been coming down the pike and ever changing, as we all know. This morning, we will be engaged in some really great conversation, and that's the key, is conversation. We want it to be interactive. So we ask that you utilize the Q&A feature at the bottom of your screen, the chat box, drop any comments or questions in there as well. And as we go through, you can also use the raise hand feature and we'll unmute your microphone. So we want to make sure that we can help to answer any of your questions, and we're looking forward to Stephen presenting some really key information here on how you can best leverage the resources that are out there. And with that, Kathy, would you like to say a few words?
Thank you, Christina, and good morning, everyone. And the Kenton Chamber of Commerce is very excited to be the third day of this Resilience series. You guys have had a tremendous lineup of speakers. I'm very impressed with that. Christina has done such a great job of organizing that, and it's difficult these days when there are so many topics that have to be discussed. We're all in a whole new world, obviously. And what we really found here was a gem in Steve Turner at the Bonadio Group. They have really taken the deep dive into all of these programs and just how they interact with one another. And I think that was the biggest thing I took away from some of our conversations recently, was that if you're getting multiple sources of aid, of grants, of aid, whatever, from the government, that when you do go to qualify to have them forgiven, there are a number of things you have to have in consideration. And when he was speaking to us, I didn't understand it. So he does a great job with this little presentation of explaining that. So I'm not going to take up his time. But then again, Christina had mentioned questions and answers. So please, ask your questions. It's a time with the Bonadio Group, who not, many people have contracted with, because they're just, they're a good sized corporation, and but very, very informative. So I'm very excited to hear what he has to say, because even though I actually already read the slides, I still have a lot of questions. So I know that goes right back to the businesses we represent. So Steve, welcome this morning.
Thanks so much, Christina. Thanks so much, Kathy. Happy to be here with everyone this morning, and happy to make this as conversational as possible, like Christina mentioned too. Interrupt me, use any of the features, will bring it to my attention as I'm kind of talking here. As a loose agenda, I'm looking to speak for maybe about 30 minutes and cover some things that you might know as a refresher, and also do a little deeper dive or make you think about a couple other things in a different way or a different light. All of us, all of the business owners on the line, CPAs, advisors this year have, no one's been able to escape dealing with the PPP or Paycheck Protection program or employer retention credits throughout this past year. And although I think everyone has had exposure to it, there's some interesting things to kind of consider along the way as you plan to continue forward post-pandemic here. So thank you for the intro. A little bit about Bonadio just to kick off here. Bonadio was formed in 1978, so we're about 40 years old or so. We have actually about 850 employees across New York State, Vermont, and Dallas, Texas. And a reason that I bring that up too is due to the size of our firm, we've been able to actually really focus on the Paycheck Protection Program, the CARES Act, we've been able to dedicate a number of our professionals, myself included, to studying this and really getting good at the chess game that is the CARES Act or the CAA within here. Disclaimer that I'm required to put into any presentation that I speak to on these topics. It's intended for general educational purposes, informational purposes, and it doesn't replace specific specialized independent professional advice. So let's dig right in here. So as I mentioned, I think everyone at this point has at least a base level of familiarity with the Paycheck Protection Program. So let's do a little refresher here. All of the first draw loans, which originated in 2020, or if you want to get technical, you could have had a first draw loan within the second window of 2021 as well. But all of the loans that originated in 2020 have ended their covered period, which as a refresher could be, as modified, anywhere from 8 weeks to 24 weeks. And also, as a refresher, the first round of loans, regardless of the type of business or your type of entity, consisted of 2.5 times your average monthly payroll. So if you do some quick math, all things held equal, pre-pandemic levels, you're talking about spending down about 10 weeks of payroll in anywhere from 8 to 24 weeks. As I'll touch on in a second here, it doesn't all need to be payroll, but that's often how people think about it, business owners think about it when they're considering their spend down here. As I mentioned, with all these 2020 loans having ended their covered period, the clock's ticking for forgiveness. I get the question often, when do I have to apply for forgiveness? And the answer is 10 months after the end of your covered period. And the end of your covered period is a different answer for every single business. It could be as much as the date you received your money, plus 24 weeks, plus another 10 months after that. And if you think about people who got their loans in March or April of 2020, the clock's ticking pretty quickly. We're in the range of maybe about 60 days out, give or take, for that first wave that's going to come up to be due to apply for forgiveness. But as I'll talk about in a few minutes here, there are a bunch of things that I want everyone to kind of consider before they rush to just getting this checklist or to-do list item off their plate. I understand the burden that every business owner is facing right now. It's constant change, it's constant adjustment, just so many different challenges regardless of your industry. And my only caution is there might be a better way than just getting this off your list right away haphazardly. And like I said, I'll talk about that a little more. So that was the first draw loan or loans. And then this, through the Consolidated Appropriations Act, which was at the end of 2020, it kind of kicked open a second window of PPP. It re-upped the funding on this. And businesses who were eligible, and here are a couple of the criteria, they may have been able to get a second draw loan. These specific, although there were eligibility requirements for the first draw loans, it tightened up and it got a little more specific with the second draw loans. So I'm only going to touch on this for a few seconds because my understanding is not only have most major banks closed their window in advance of the end of the program, which is May 31st officially, I was informed by a bank that operates locally just yesterday, actually, that the bank had been informed that all the SBA funding had been exhausted. I haven't seen that really clearly out in the news, but take that for what it's worth. If you're not in at this point, you're gonna have a really hard time finding a lender to move forward with now. But let's touch on it. Second draw, 300 or fewer employees. You must have demonstrated a 25% or more drop in quarterly revenue comparing 2020 to 2019. For all of these loans and for the employee retention credits that I'm going to speak to as well, it's you need to consider affiliation rules. A confusing piece within here is if you own multiple businesses or potentially a group of owners own multiple businesses, you may need to kind of join those together and consolidate them for the purpose of this testing, both for headcount and both for drop in revenue for your second loan. The PPP runs on the SBA rules for this, and the employee retention credit runs on IRS rules or Internal Revenue Code rules. So they did a really great job of making it extra confusing for everyone because nothing has the same set of rules within here. So, interesting point that I think gets glossed over often is that both rounds of these PPP loans for forgiveness purposes require at a minimum a 60% spend on payroll costs. And payroll costs, as defined, are wages, state unemployment taxes, small piece, and group healthcare. Group healthcare can have sometimes a broad definition depending on your industry. Think about construction contractors that may be a union shop and pay union dues, which cover group retirement, group health. That all could be included or may be included within this 60% payroll spend window. Why is that important to you? As I'll talk about, the more payroll, eligible payroll that you leave on the table, the more you may be able to claim in employee retention credits. So as I mentioned earlier, there's more to consider than just getting this to-do list item off your plate and saying, oh, the easiest way is for me to send in my payroll records and send 24 weeks of payroll records and blast this thing through 100%. Now, if you already did that, if you, let's say, had a loan for maybe $100,000 and earlier, maybe early 2021 or potentially even at the end of 2020, you submitted for forgiveness and you said, I blew this thing out of the water. I want to get my letter for 100% forgiveness. Not only did I spend $100,000 on payroll, I spent $300,000 on payroll. You can actually, you do have the opportunity to kind of go back, the IRS has said, and consider it as if you only submitted the exact amount of your PPP loan. Now, is it quite as good as only having submitted 60% spend? No, but it still leaves some good opportunity on the table here. Another thing to consider is through the Consolidated Appropriations Act at the end of 2020, these non-payroll costs expanded dramatically in some cases. So I'll touch on this in a second here under employee retention credits, but this is something that I think every business needs to kind of consider. It's not quite as simple as, well, I didn't have a big rent expense or utilities didn't make up a lot of my spend, so who cares? I'm not going to look at that. There's more to this. So I'm going to flip forward actually one more slide and come back one to show you. I have a chart on here that's not super conducive to live discussion, but I wanted to include it in here. And at the very end of the presentation, I'll give you my contact info. Anyone who would like a copy of the slide deck, feel free to reach out. But here is the most black and white way that I can kind of show, depending on the size it shows on your screen, the differences between the employee retention credit for 2020 and 2021. Now, that being said, for the purposes of the presentation, here's a couple highlights that I'll touch on because it can be overwhelming. There's a lot to consider. And as Christina and Kathy mentioned when we first talked, just kind of scoping out what would I speak to or what could I speak to that would be valuable to the membership. Employee retention credit was a big chunk of the conversation. So some key considerations. Even as we sit here today on May 12th, you can go back, if eligible, and claim this credit for 2020. that was a change that happened once again as a result of the Consolidated Appropriations Act at the end of 2020. It said it made the change that not only did it increase the non-payroll costs that were eligible to be claimed for your PPP forgiveness, it said, hey, this consolation prize, which is really what it was before, of the employee retention credit, if you're not eligible for a PPP loan, too many employees, et cetera, you could potentially claim this credit. Now, when it was a one or the other situation, PPP was the better option all day. 100 cents on the dollar, way better. It was a no-brainer. But if you can have both, that's pretty awesome too. So for 2020, this credit, jumping down a couple bullet points here, could be worth to you $5,000 per employee for the year. And then as we talk about 2021, this credit could be worth to you $7,000 refundable per employee per quarter. So I'll throw some napkin math to this as we speak to give you an idea of why you should care about this and why you should maybe reconsider your eligibility. First thing, which I think a lot of people don't realize, is through FAQs, through IR, Internal Revenue Code rules, and some other guidance that's been issued on this, headcount. So there is a threshold that will determine how valuable the credit is to you for both 2020 and 2021. The sweet spot for 2020 is going to be if you have under 100, or I'm sorry, if you had under 100 full-time employees in 2019. A lot of this program, you'll see references back to 2019. Why do you care that I was so specific about full-time employees? Think about restaurants as a great example. Think about how many part-time employees restaurants have. In total, if you're looking at them as full-time equivalents, it may add up to a lot of employees. It may add up to over 100, in fact. But if you start to focus in on a full-time employee, defined the same way as in the American Care Act, which is 30 hours per week or 130 hours per month, and you do that calculation, who's a full-time employee, January, February, all the way through December of 2019, you'll have 12 numbers, you'll add them and average it. If that number is below 100, you get to claim this credit for wages paid to any employee for time that they spent working or time that they spent not working. Now, the not working piece is obviously not going to be as valuable for people. In some cases, if you determine that you had over 100 employees, full-time employees, you may decide that this credit's not going to be worth it to you necessarily to go after, but that can be scoped out pretty quickly to determine what we might be chasing here. Now, the great part is 2020 has that 100 employee threshold. 2021 has a 500 employee threshold. So it scopes in far more businesses within 2021. The other great part is, even though the headcount is calculated based on only full-time employees, the credit itself is calculated based on all employees. So you could take 50% of up to the first $10,000 in wages per employee, either for the year of 2020 or for 2021. You could be taking up to 70% of the first $10,000 in wages per employee per quarter, if you qualify. Let me hit one more thing, and then let's do some napkin math to, for an average business. Another thing I wanted to really stress here, and what I encounter most often when I get on a call to consult with a business on these topics is, hey, Steve, I don't qualify for this because I didn't have a 50% decline as required for 2020. And that very well may be the case. A 50% decline in top line revenue, or gross receipts rather, is a pretty steep threshold to meet. But there is a different way to qualify for this credit as well, which is full or partial shutdown. So think about executive orders that were issued maybe in March of 2020. And as a side note, all of these executive orders are accessible through the New York State website, government website. Consider both New York restrictions and potential Erie County restrictions, which would be more rare in these cases. Oftentimes we're dealing with New York State restrictions, but let's take an example, two examples that are kind of low-hanging fruit in my opinion. First one that I go back to is restaurants. There is an incredible amount of opportunity here for restaurants. Oftentimes you can sneak in under that 100-person full-time headcount. And from March 16th of 2020, where restaurants were either fully or partially shut down due to executive order, that still is ongoing today. Think about any restaurants that you might own or go to, still at 75% capacity, still have a curfew. My understanding is that on May 17th, it's not a decision that's restored, it's a decision that a decision will be made on the 17th. So why is that important? You have about 14 months running on the clock to be able to claim this credit right out of the gate. Now, let's go a little deeper with this restaurant credit example, and I'll show you with a little chart here coming up, but you want to maximize your non-payroll costs when you're doing this because it leaves the most payroll on the table to claim this credit. So the beauty of the expansion of these non-payroll costs are things like, everyone brings up to me, personal protective equipment. Okay, great. Yes, you can utilize that. Did you spend $40,000 on it? Probably not. But it's something. All the old stuff is there too, utilities, rent to not related parties or third parties rather. But for restaurants, you get to claim, if you look at the actual forgiveness application itself, it mentions this, purchases of perishable food during your covered period. So even if you were restricted, you were still buying food, perishable food items to sell, to prep and sell. All of that counts. So in my experience, what I have found is when optimized, we're able to kind of get up to that 40% level, leave as much payroll on the table as possible for the credit, and kind of have our cake and eat it too. Hit 100% forgiveness on our PPP1, claim the ERC and max it out for 2020, and then kick into 2021 and still claim the ERC for Q1. I'm hoping that every NAICS code 72 full service restaurants got in for a 3.5 times average monthly payroll loan, a bigger second draw loan, and we repeat this process. There are some things to consider. There's some really specific and more granular considerations on a case-by-case basis on this, but what we have found is there is a ton of opportunity here. That was restaurants. Now let's think of another one that sometimes gets glossed over, construction industry. Unless you were an essential industry within construction, you were fully or partially shut down for a period of approximately 8 weeks. It's like mid-March to mid-May 2020. You can claim the credit for this shutdown period, even if you didn't hit the 50% decline. And that's the thing that I think people struggle with is these are separate things. Arguably, you could have maintained business levels, top-line business levels at 90% of pre-pandemic levels, and you can still claim this credit for your shutdown period. So a lot of talk about this credit, but I think it's super important. At the bottom of this slide, a key consideration, and this is why I even mentioned the Paycheck Protection Program along with this discussion, is that there is no double dipping. So you really need to play the chess game. You need to be strategic regarding the interplay between these programs and credits. So think PPP, Paycheck Protection Program, ERC, Employee Retention Credits, Shuttered Venue Operators Grants, which some of you may be eligible for, depending on who's on the line, HHS funds, Health and Human Services. Various grants were available to medical practices, dentists, doctors, etc. And there are other opportunities where that might come into play for consideration. Do you claim an R&D credit? Did you claim credits for under the Families First Coronavirus Relief Act? Did you claim credit for paying people to stay home? And this is a great point to kind of interject that working with an advisor in these cases can pay back exponentially, not only on misstepping on this, but if you miss something here, you could be leaving a significant amount of money on the table. So enough talk about that. I'll pop this up for a second and just kind of, I'm a visual learner. So as much as I was talking about this, I'll stop on this for about 30 seconds or so. But like I said, please feel free to reach out if you'd like a copy. But another reminder too, the 2021 employee retention credit runs through the end of the year. So actually this slide deck is not updated to capture the extension of this program through the end of 2021, 4 full quarters. So you're talking about 7 out of 8 quarters over a 2-year period where you may be eligible for this to consider either a decline, substantial decline in gross receipts, which I don't know if I mentioned, but the 50% decline is for 2020, but it not only was the headcount bumped up to get more people eligible, more companies eligible, but the significant decline threshold got reduced as well. So you only need to meet a 20% decline. And another key misstep that I see is people will compare their 2021, maybe first quarter, to their, or second quarter is a better example, second quarter 2021, and they say, well, I'm monitoring this target level of second quarter 2020. 2020, pandemic year, doesn't count, throw it out. You have to look back to 2019. So if you had a representative or a strong 2019, you really extra need to be looking at these because there is a very good chance that you can jump on all these things. Let's take a super basic example here of optimization and what this credit might be worth to people. This is an example based on 2020. Company AAA has 75 full-time equivalents in this case, and is eligible for Q2, Q3, and Q4 based on a significant decline in gross receipts, meaning they were hit hard in 2020. They had at least a 50% decline or more in the second quarter of 2020 compared to the second quarter of 2019. Another point that I'll mention, but is at times high level for a presentation like this, is in order to qualify for Q2, Q3, and Q4, you didn't necessarily need to show a greater than 50% decline in each of those quarters. It kind of works in a way that you're in and then you don't get kicked back out until you restore your gross receipts levels to within 20% of the prior year's quarter. So in this case, this made up case, let's say that they were down 55% year over year, Q2, and then they were only down maybe 25% year over year in Q3. You're still in. You don't get kicked out until the quarter that you remedy this decline. So it's at a minimum, if you're in based on significant decline, you're in for at least 2 quarters. So plenty of money on the table here. For this fake example, let's just say that each of these employees make $10,000 gross per quarter. Let's also say that the company received a first draw PPP loan in the amount of $625,000. And the way that the number was arrived at was working this 75 times 40 grand divided by 12 to get an average month times 2.5. With the covered period beginning and ending within the ERC eligible period, meaning they received the loan sometime within Q2 2020, real life, and 24 weeks expired before the end of the year 2020. Let's also assume that this company has enough qualifying non-payroll costs during their covered period to hit that 40% threshold that I had mentioned earlier. Here's the best way that I can visualize some of the work that I do or that we do with this program. As I mentioned, this timeline represents the entirety of the timeline in blue and orange represents the entire period that the employee retention credit is available to this company. And the middle orange period represents, let's say, 24 weeks of PPP1 covered period. So what you kind of have to think about here is the orange window. You cannot go outside the orange window to pick up payroll or non-payroll costs to cover forgiveness for your loan. However, you can dip into the orange window to pick up employee retention credits. Why is that important? For anyone who made over $10,000 in the entire period, now this is an extreme example that this company is eligible for 3 quarters of 2020, but think about it for 2021 as well. If you have employees making $40,000 or more on average, someone who makes maybe $80,000 is making approximately $20,000 within 1 quarter. So why should you care? Like I said, $10,000 of this can be allocated to max out the employee retention credit. The leftover, the overage, can be allocated or may be able to be allocated to the PPP loan forgiveness. This is where I mentioned some time spent with an advisor can really pay off huge when you're kind of applying the more intricate rules within here. As I mentioned, this strategy sort of continues on through 2021 with the PPP second draw loan and the extended ERC there too. So let's say that you're a business owner who, I'm going to make it easier on myself here and say that you received your second draw loan on April 1st, 2021. If you're a restaurant or another business that's still encountering shutdown, full or partial shutdown, you can claim the ERC, max that thing out for 2021. For the second quarter is really where you have that overlap there. You have a PPP covered period window, and you have potentially ERC eligibility within. This is where you need to kind of be very specific. You might be able to hit some of the threshold with wages over 10 grand. You may have to kind of cannibalize one or the other if you don't have levels that support full forgiveness and full max out of the ERC. One thing that I didn't touch on here, let's talk about this fake company with 75 employees. As I said, let's say that all of them max this thing out. They have at least $10,000 in credit. We're talking about 75 employees times $10,000 a piece. For 2020, it's 50 cents on the dollar, $375,000 of refundable credit. Lever that up or down based on your own business to give you an idea. But the beauty of this thing, kick it over to first quarter 2021 alone, not even a year's worth of time, 1 quarter, Do that same calculation. 75 employees, all making at least $10,000 per quarter, to $750,000, except now it's 70 cents on the dollar, $525,000. So between the two of those, 2020 and the first quarter of 2021 alone, you're talking about $900,000 for a company that has approximately 75 employees. You can see that this adds up very quickly. And as I said, it's on top of the other opportunities that are available. So do not, I'm urging everyone to at least consider this opportunity for 2020 and 2021 as a business owner here. A couple boring things here, but I'll still touch on because I think they're important. You know, I'm a nerdy accountant, so I have to talk to you a little bit about how does all this stuff get accounted for? Maybe some stuff that you are aware of, and maybe some stuff that you're not aware of with this too. Paycheck Protection Program loans are accounted for under an elected accounting policy. And I'm going to boil it down. There's really kind of three options, but there's two options when you boil it down. It's either you account for it under a debt model or a grant model. How does that work? You receive a loan in 2020 and your covered period ends. You feel good. You have it well documented that you believe you're going to receive 100% forgiveness, but based on guidance from an advisor who may have told you to hold off a second, or your workload or uncertainty, or et cetera, you don't even get around to considering applying for this thing, for forgiveness rather, until 2021. Keep in mind that one parameter of getting a second round loan was that you had to attest that you had spent down the entirety of your first round loan. Doesn't speak to applying for forgiveness, just spend down, two different things. You have two options in this example here. You can say, look, I still owe this money until I'm told otherwise. So I'm going to present it under the debt model, meaning it's a Paycheck Protection Program loan with specific loan provisions. Depending on the time that you received it, it's either a 2-year or 5-year term with probably a 1% interest rate. Your mileage may vary on that. It would stay on your balance sheet as debt at 12/31/20 under that first model. The other option that you have is to account for it under the grant model, where you can say, look, I didn't apply for forgiveness before the end of the year. However, I have met and documented, I've met all the parameters, and I've documented that I've met all the parameters set for forgiveness, meaning my headcount is right if it's required for your specific loan application or forgiveness application. I've spent everything down on qualifying covered period expenses, and I'm near certain that this thing is going to be 100% forgiven. You could elect to account for this under the grant model, where you say, I'm going to take it into income, other income, when I hit the qualifying spend down parameters and other parameters. So under this model, you may be able to take this into income within 2020, even though you haven't received forgiveness yet. Something that every business owner should kind of consider, every business owner with bank debt with covenants, is there may be a covenant impact here. And I say maybe because it's kind of a bank by bank situation. It's interesting. Most covenants, most borrowing, assuming that you borrowed pre-pandemic, this didn't exist at that time. So there is nothing written into these covenants that would specifically speak to treatment of Paycheck Protection Program loans. Also, the concept of an extraordinary accounting item. got ditched a couple years back. So that doesn't exist either. So if you have a very old written covenant that hasn't been amended, maybe you have something like that, but this doesn't fall under this either. It would be reported as other income on your P&L, and depending on what you elect and the timing, either it would be sitting on your balance sheet as debt, or forgiven. But you have to kind of consider that this is an accounting policy election. So whatever you pick now for your 12/31/20 year end, you're going to have to live with for your round 2 loan. So if you elected the debt model and you apply and receive forgiveness on your first round loan within 2021, and then you got a second loan, and then you apply for forgiveness within 2021 on that second round loan, your statements could look kind of wacky, depending here. You'd have 2 rounds of loans that would be coming through as income. Might be a bad thing, might not be a bad thing. It's definitely not a taxable bad thing necessarily, because PPP forgiveness is non-taxable for federal and New York State purposes. I'm not a tax guy by trade, but my understanding that I'll pass on to you is that there could be some other positive impacts of taking this loan into income in 2020. It creates basis. So if you have some losses that you'd like to claim and get the benefit of, this loan forgiveness creates basis. It's kind of a two double good things here, non-taxable and creating basis. Now, the employee retention credit, this is a different story. If you're eligible for it within 2020, you can go back and you claim it by amending a quarterly payroll tax return. So it would be claimed at a 941X. However, it's supposed to be, per the Internal Revenue Code, reported within your 2020 tax return. Many of you on the line may have already filed your 2020 tax return, and therefore you're looking at this like, what do I do? You may have to go back and amend your 2020 corporate tax return for this. That being said, the presentation, it's effectively, the ERC is effectively taxable. And what do I mean by that? It's netted against deductible wages as reported on your tax return. So a credit applied against a deduction, meaning you have less of a deduction, therefore taxable. So there are some interesting outcomes with this where you may be claiming this credit now, or maybe you've just claimed it, but I can tell you that it's not going to be a quick process of getting that money back in your hands if you claimed it via an amendment. So you may not get this money for 6 months. 6 months may be a blue sky scenario, in fact, after the time that you file for this, but you may be due to pay tax on this credit before you've received the cash. Pretty unique situation, unique scenario that doesn't really match up with the normal way that taxable income flows. So that's a lot of talking. I'm going to pop up my Bonadio baby picture on here. And there's my contact info as well. I'd encourage any of you to follow up with me if you have a question, or if you'd like a copy of the slide deck as well. I'm going to defer back to Christina and Kathy here. I don't see any questions in here.
Yeah, I don't see any questions in there yet. So just a reminder, feel free to access the Q&A or the chat box to drop in any comments or thoughts that you might have. And I just wanted to verify too. So when looking at ERC, if it's a full or partial shutdown and that will qualify the business, then is that right that they wouldn't have to show at all the 50% decline in gross receipts?
That's correct. It's an either or scenario. The more comprehensive way to qualify and the bigger period to qualify is generally going to be the significant decline. But in the case of, I always go back to restaurants because it's a very visible, tangible example that everyone's aware of. Restaurants have not returned to zero restriction yet since March 16th of 2020. So they would qualify with the clock running from March 16th, 2020 through today as we're speaking, at least. But you're right. If you qualify based on full or partial shutdown, you're going to be focusing in on the window that you were shut down. So for a home builder who was shut down for maybe 8 weeks, depending on the size of your business, your headcount rather, you may be able to take this credit against all wages paid within that window to all employees, regardless of if they were working or not, during that shutdown window specifically.
If those same people then went on unemployment?
Sure. So the credit, the ERC, is based on wages paid to employees by the business. So headcount has nothing to do with ERC in terms of like the reduction or things that you may have to consider as part of the PPP loan. But I would argue that if an employee is going on unemployment, then you're not paying them any wages. Therefore, you're not going to have the base expense to claim the credit against.
So yeah, let me, I think a lot of businesses were deemed non-essential, just like almost everybody was non-essential. So I'm confused about that, just because obviously the restaurants were shut down, but then, even I was in limbo. We're not essential. I mean, we're not, we were, but we weren't. So where do we fit in?
You have to consider, yeah. So let's take, more along the lines of a firm, a professional firm, accounting firm. We were able to transition to full remote. Now, we were restricted on in-person visits for a period of time, but if your business was able to transition to full remote under the executive order, then you likely won't qualify based on this full or partial shutdown. I understand your comment that most or many businesses were deemed non-essential, but when you start to really dig into it, a lot of construction industry has a split. Those that were doing, for example, road work or bridge or infrastructure, essential. They're allowed to keep rolling. Let's say there's a contractor that works solely on schools, perhaps. That might have been stopped. Think about mechanic shops, essential, not shut down. And I always think about it in terms of you can verify it by going to the governor's website, but I always kind of think about it like, what services are required to keep essential workers moving forward? Yeah, your car breaks, you need it fixed. You need to go to the grocery store. You need to go to the doctor still. Of course. So that's kind of how I think about it. Financial services largely were unaffected in many ways in terms of shutdown for determining ERC, but it's 50-50 from what I see talking with businesses, because I'll have phone calls, scoping phone calls, and sometimes, as I told Christina and Kathy previously, we'll start the conversation at, I've already thought about this, I'm not eligible. It's like, well, hold up, let's talk specifics here of what happened. And I would say 50% of the time, we, through conversation and going back a year in memory and then verifying, we get to a point where we say, there's something here that we can really firmly stand on to claim this credit. So it's a complete mix. I wouldn't make the blanket statement that most businesses were deemed non-essential, because when you really start to dig into it, there were a lot that may have had some partial restriction for a little period of time. Home builders are always another great example. Home builders were restricted from to one person being on site at a job site for a period of about 8 weeks. That definitely counts.
It would, because most of these places you can't have just one person on a job. You've got, okay.
Correct.
Well, thank you again. I know it looks like we don't still see any direct questions that are popping up on the live presentation here, but everyone has Stephen's contact information. We can share the contact information along with the presentation and some follow-up afterwards. But I think, a big takeaway as we go through all of the details and the kind of what ifs and the if this, then that scenarios, the big takeaway is there are so many nuances to the programs and the tax implications that are available that it's so helpful to be able to connect with, a firm and an organization that has the expertise. And we're glad to have the Bonadio Group as a member of the chamber and a resource. So Stephen, thank you for the time that you spent today sharing and walking through our members through the nuances that are there. And the big thing, right? And we've said, don't leave money on the table. And I think you've really covered some key ways to be able to think how they might be able to best optimize what they can there. So Kathy, any final words on your end?
We just really appreciate the Cheektowaga Chamber for, joining us in this and hosting this program. And of course, Steve Turner, for taking your time this morning with some really, really valuable information. I needed to hear it about 3 times. So I might watch that again, but this is my 3rd time because I read the slide deck and I just was, and it has helped to just get a higher level of realizing there's a lot more questions to ask based on how your company files and how many employees there are and everything else that was involved. So just don't throw in those PPP loan forgiveness applications too quickly. Take time to think about it. And thank you both.
And thank you so much. Yeah, thanks both of you for for having me, and I think that's the key takeaway here too is don't assume, and there is money available here for business owners. There is help, and I think this has been a fantastic opportunity for our firm in this past year to be able to dedicate the resources to helping business owners in the markets that we operate in, and nationally. We've been able to get some great national outreach too, as a function of the expertise with this, and it's rewarding to be able to help families and business owners in the local markets that we operate in survive, sustain, and hopefully as a result of some of these programs thrive and continue.
Absolutely. On to the long-term economic recovery. So thank you again to the members of the Kenton Chamber joining us and the members of our Cheektowaga Chamber. You'll be able to access the recording after the fact, and stay tuned to the rest of the webinars. Tomorrow is our final day of the Resilience series that we organized for this week, and we're going to be focused on strengthening and protecting your digital brand. So we'll have in the morning a presentation, 9 a.m. from the Better Business Bureau of Upstate New York on your online reputation management and really taking control of the information that's out there about your company, your organization online. And then we will cap it off in the afternoon with a presentation at 1 p.m. by Spectrum Reach on 3 digital advertising essential tips. So really be mindful of what content you're putting out there and how they can assist. So again, thank you to everyone for joining us, and we'll be in touch. Have a wonderful afternoon.